Welcome, everyone. If you're a business leader, corporate strategist, or maybe a real estate pro tuning into this explainer today, you probably feel like you've got a pretty solid read on the market, right? Well, right now, just beneath the surface of Japan's economic recovery, there's this massive, completely hidden structural shift that's fundamentally rewiring the commercial real estate landscape. I mean, we're seeing data that completely defies what you typically expect in this kind of economy. So let's dive right into this and decode what's really happening. Because what we're going to uncover today, it's going to directly impact how your company operates, recruits, and grows over the next decade. Okay, here is a really quick roadmap for our explainer today. We're going to start with a surprising market boom. Then we'll shift gears into the war for talent, check out the logistics area gap, and finally, we're going to uncover what we call the invisible dividing line. I promise to take you from the shocking surface-level data right down to the strategic core of what this actually means for you. All right, Section 1, the surprising market boom, breaking records. When we look at the current market data, it honestly feels like it belongs in a totally different economic reality, 1.37%. Actually, let that sink in for a second. According to the Eximux Real Estate Institute, that's the projected office vacancy rate in Tokyo's 23 wards for the first quarter of 2026. It has plummeted right down to the early 1% level. And what's even more staggering, the new contract rent index has hit 108. That literally exceeds the incredibly favorable market conditions we had right before the pandemic. In the central 5 wards, asking rents have been rising for 5 consecutive months. So you kind of got to wonder, why? Why are rents breaking pre-pandemic records right now? I mean, we're dealing with soaring inflation, right? We've got massive spikes in construction costs. Traditionally, those factors make companies tighten their belts and just crush real estate demand. The absolute key takeaway here is that this is not just some simple cyclical economic bounce back. Something completely different is driving this crazy demand. To really wrap our heads around this boom, we've got to look at a massive paradigm shift. See, the old mindset? It basically viewed real estate as just space, a place to put desks, heavily managed as just another overhead cost. But the new mindset treats real estate as a premium environmental value and an absolutely crucial human resources tool. So even when anticipating future costs going up, companies aren't downsizing. They're actually rushing to relocate to better bases, specifically to upgrade the working environment for their teams. And that brings us to Section 2, the war for talent, weaponizing the office. Weaponizing might sound a bit intense, but it's totally accurate. The office building itself has essentially been weaponized in the fight to acquire the absolute best people. Relocation isn't just about square footage anymore. The real engine behind this massive office demand is employees returning to the office, colliding with a severe labor shortage across Japan. Companies are openly admitting it. They're relocating to strengthen their recruiting power, boost employee engagement, and build up their corporate brand. The office is basically the new flagship for attracting excellence. And this is a really fascinating point, this boom is absolutely not universal. Because tenant expectations are just so incredibly high now, we're seeing a really stark divergence in the market. Areas like Yaesu and Nihonbashi, extremely high demand. They've got the top-tier facilities and the perfect locations. They're effortlessly absorbing huge new supplies of office space, which is driving up rents. Owners there even have the pricing power to introduce consumer price index-linked rent hikes. But then contrast that with an area like Shibuya, which is seriously struggling with tenant mismatches. The older buildings just don't meet these new, high-level corporate demands. And in places like Shinagawa, they're dealing with deep fears of an oversupply. Basically, if a building lacks that high-end environmental value, it's rapidly losing out, completely regardless of the broader market boom. Moving right along to Section 3, the logistics area gap, bipolarization. So let's look at how this plays out in the broader commercial landscape, because this exact same structural shift, the huge focus on human resources and efficiency, is totally transforming the logistics and warehouse sector too. We're seeing this incredibly stark geographic bipolarization. Over in the Kinki area, the vacancy rate for large multi-tenant logistics facilities is so tight, just 2.2%. New demand there actually just hit a historical high. Greater Tokyo is also looking solid at 9.2%, with rents rising across the board, especially around Tokyo Bay. But then look at Chubu, 16.8%. Over there, new supply is completely outpacing demand, and buildings are literally just sitting empty. And we're seeing the exact same thing play out in Fukuoka, where vacancies hit 8.3%. In the logistics world, tenants are hyper-focused on great locations with excellent traffic access and, crucially, great working environments for their staff. If a region or a specific facility lacks that, it's getting left behind. And it's not just about where these warehouses are, it's what they actually need to handle. Shippers' needs are rapidly diversifying way beyond just traditional manufacturing. We're talking massive new storage demands for food, daily necessities, and medicines. Because of this, companies are actively looking to consolidate multiple older, clunky bases into a single, highly efficient, ultra-modern location. They want to do way more with less space, but that space has to be incredibly sophisticated. Which explains this crazy number perfectly. High-spec, large multi-tenant logistics facilities are receiving constant, aggressive inquiries, even at premium rents exceeding 4,000 yen per Tsubo. That is a staggering premium in this market. But companies are happily paying it because these facilities completely solve their high-level operational and HR headaches. Okay, let's bring it all together. Section 4. The invisible dividing line, winners and losers. Everything we've talked about today builds up to this one singular reality that's now defining Japanese commercial real estate. We call it the invisible dividing line. Behind all the bullish macro indicators and those record low vacancy rates we've been talking about, there's a ruthless selection process happening right under our noses. Tenants are quietly separating the market into winners and losers. On one side of the line, you have assets that offer premium environmental and efficiency value. And on the other side, you have properties that are merely empty spaces. If you own an asset on the wrong side of this line, you're going to be left completely exposed. To make sure you stay on the winning side of this dividing line, property owners really need to hit 3 sequential targets. Number 1, you've got to implement the absolute latest facilities. Number 2, secure excellent traffic access. And number 3, provide premium surrounding working environments. Tenants are so acutely sensitive to geopolitical risks and external environment changes right now. If a property can't satisfy those 3 things, owners won't just miss out on the rent increases. They face a very real, very severe risk of massive tenant exoduses. Our source material really hit the nail on the head with this quote. The market has completely shifted its value standard from the quantity of space to the quality of functions and environments. Think about that for a second. Tenants are no longer just paying overhead costs. They're demanding aggressive returns on their real estate investments. They expect their office to actually give them recruitment competitiveness and their warehouse to provide dramatic logistics efficiency. A space without a high-level function, it's literally a liability now. So I want to leave you with this to chew on with your executive team this week. Does your company's current real estate strategy put you on the winning or the losing side of the invisible dividing line? Are your spaces actively fighting for your talent and your efficiency, or are they just overhead costs holding you back? The market is shifting incredibly fast, and that divide is only getting wider. Thanks so much for joining me on this explainer today, and I'll catch you next time.